The Fed has raised rates as expected by 50 basis points, and the dot plot is indicating that the peak rate will be 75 basis more, between 5 and 5.25. That will be in 2023. But there are no cuts till 2024. However, the market still seems to pencil in that the Fed may stop before that the peak will be less than 5. To assess the impact of the rate hike and the Fed's continued fight against inflation, we are joined by two experts: Vishnu Varathan, the Executive Director, Head Economics and Strategy at Mizuho Bank, and Aditya, Bhave, the Senior US and Global Economist at Bank of America Securities. Vishnu, with your permission, I'll speak to Aditya first. He's staying up the night for us. Aditya, like I pointed out, the majority of the Fed members are expecting that the rates will go a further 75 basis to, a median of 5.12. What's your take?
Yes, Lata. So that's in line with our forecasts for the terminal rate. We expect the Fed to hike 50 basis points in February and 25 basis points in March. The dots were relatively hawkish in the sense that there were actually 7 of the 19 policymakers expecting even more hikes than 75 basis points next year. But broadly, the dots were what we were expecting. They also have 100 basis points of cuts in both 2024 and 2025.
Okay, then the obvious next question: what's the impact on the economy? If you noticed in the press conference, Powell himself refrained from commenting on the extent of recession, still believes it can be soft landing.
Right. So the Fed is probably a little bit too optimistic on the trajectory of the economy and the unemployment rate relatedly. So we expect a recession next year. We think it probably starts in the first half, but there is a risk that it could get pushed off to the second half. In any rate, it's not going to be quite as soft a landing as what the Fed is expecting. As a result of that, the unemployment rate will probably also rise more than what the Fed is expecting. So we have a contraction of about 1% from peak to trough next year, and the unemployment rate should rise above 5% by the end of next year as well, in our view.
So you're saying that you, contrary to the Fed, you are expecting the US economy to contract next year?
Yes, that's correct. It'll be a contraction of a few tenths next year. Yep.
Okay. Now, just a word on the impact. The dollar index, the DXY, didn't strengthen even after Powell retained, or even the statement retained, its hawkishness. So what does that indicate?
Right. So the reason that markets kind of did a U-turn during the meeting was that while the economic projections were quite hawkish, there was a comment from Powell. I don't think he was intentionally dovish, but there was a comment from Powell that markets interpreted as somewhat dovish. Specifically, I think he left the door open quite significantly for another shift down to 25 in February. And if they were to make that move, then markets would start extrapolating and thinking about, okay, well, then when does the Fed pause? After that, how long do they stay on hold? When do the hikes start? So that shift down, that potential shift down, I think, was what got the markets to basically do a U-turn from seeing this as a broadly hawkish Fed to seeing it as somewhat neutral relative to expectations going into the meeting.
Okay, got that. Well, Aditya, just stay on for a minute more. Let me get Vishnu in. Vishnu, now, what is your understanding of the impact of all this on emerging markets, especially currencies, because the dollar has not strengthened?
I mean, that's really one of the things we are struggling with. So as you rightly pointed out, the dollar capitulated instead of strengthening. That could partly, and I agree with Aditya on the referencings that market got, could also be because historically they're looking at the dollar peaking well before we hit peak rates, and Fed suggesting we come quite close to that. However, we don't think that means that EM currencies are going to get a free ride up, unfettered and unimpeded. Primarily because for the dollar to sustain downside, we probably need to see euro and other major currencies continuing to strengthen, and that path is not so clear. So the alternative is not as compelling. And once you get into a global recession type of risk, EM currencies also tend to have at least bouts of fear and air pockets. So we think it's going to be a bumpy ride, and there's going to be downside risks, clear downside risks to EM Asia currencies going into the middle of next year.
Oh, I want to pursue that point, but let me let Aditya go with the last question. Aditya, what will be the impact of the US contraction that you are forecasting and the global slowdown on a country like India?
Yes, I think that is another concern. When the US slows, when the US sneezes, as they say, the world typically catches a cold, and I don't think this time will be any different. But as you suggest, probably for India, the downside is a little bit less than for other countries that are very exposed to US markets.
Okay, fair enough. Thank you very much, Aditya. Vishnu, to come back to you, how would you differentiate the impact? US contraction is what Aditya is saying. The Fed expects 0.5% growth in the US next year. How would it impact the countries differently? Would India be less impacted because we are not that export dependent?
That, I think, is the first order differentiation that comes through. India would be far more buffered, primarily because, as you rightly point out, the export engines are not going to be as important, and so the slowdown is not going to impact it as severely. That said, we need to also add in two other factors here. One is we need to see if you get into a global recession, and if you have a point where the recession is far worse across the Atlantic in Europe and in the UK, then would that mean that for some reason, due to recession fears, the dollar strengthens a lot more and we get to see a capital flight? In which case, twin deficit countries tend to really bear the brunt of the impact via currency markets and asset markets. So that's one other aspect of risk that India must keep a clear eye out for. The other, of course, has got to do with more generalized sentiments on how higher rates impact Asia as well. And I would like to bring, and though it's not a related topic, China into the fray here. I mean, China is trying to fire on all cylinders, trying to revive its economy. It's going to be a very tough ride there. The rest of Asia is not going to get a lift from that. But perversely, if they were to revive some of the issuances and guarantees in their bond market, we also could see a substitution back out in the credit space outside from Indonesia, Philippines, and India back into Chinese credit markets if for some reason investors are seduced. Against a backdrop of capital flowing out of EM Asia, that can again intensify the downside impact. So yes, the exports factor is not as acute for India, but we do have broader risks that generally tend to outweigh in a global recession.
Okay. Let me set aside the Chinese issue. Before that, you said that even otherwise volatility in the global markets could lead to a capital flight from India. At the moment, that's not what we are seeing. We are seeing the foreign investors legging it back to India, albeit in smaller driblets. So why would you, I mean, of course, India would have a big current account deficit even next year because exports look like they will slow. But doesn't it look like they will be financed because the FPI flows are there, the country is seen as one of the fastest growing?
No, absolutely. I take your point on that, and which is why we are really constructive on the medium-term prospects. What I'm alluding to, however, is that when we get into a bit of a crunch with a global recession, if it coincides particularly with a strong dollar, especially because there's just no alternative in the euro, the sterling, nothing else is compelling, that mix of factors means that the assumptions about the current account deficit being financed can suddenly turn, and it is this abrupt turn in expectations about how the current account deficit will be financed that probably might accentuate risks around India, and in particular the risks that come through the currency conduit. So that's a particular risk that doesn't quite fade out and durably yet. So that's really our main risk for India.
No, I take your point, but like for instance, even today, although the dollar index has not strengthened, it has in fact weakened, the rupee is weaker. So, I take broadly your point, but how much weakness do you see for the rupee? Can it go beyond the 83, 83.5 that it has already touched?
That will really come down to the severity of the global risk-off and the capital flight that we see. So without coming down to that, it will be hard to say whether or not it exceeds. But certainly we cannot rule out that it could exceed that. And to your point, and I wasn't clear enough earlier. So to your point, I agree that overall I think India's fundamentals are good. So it's really we're talking about a pocket of intense risk-off rather than a prolonged sell-off in India. So that's really the pocket that we are watchful of heading into the middle of next year, rather than looking at a gloomy 3 years. That's in fact I'm totally on board with you where it's the opposite case for the 3 to 5 year span. I do see it being very constructive for India.
Okay, no. I'm not beating my chest in favor of India. It just looks like the stars are aligned. But Vishnu, how will commodities behave? I think one of your base assumptions is that China will fire on all cylinders, at least all policy cylinders. So should we expect crude to once again charge up? We have had at least some benign run, bearish run. What's your forecast?
Well, we think crude is a bit of an expert at playing the game of chicken in this scenario. So I think crude prices could remain a lot stickier than underlying fundamentals suggest, just because they're banking on very odd counter-cyclical factors such as China resuming travel, as well as China reopening and all the demand that comes through. But we do see that what that means is that you get sticky crude prices that exacerbate recession risks. But when we really start tipping over into recession risk, the China consolation will no longer be enough, and you get much sharper falls in crude prices alongside broader commodities. So that tipping point risk with respect to crude and the sluggish risk for the rest of the commodities remain in place for us. The only question is, do we get to that tipping point and how sharp that tipping point will be?
Oh, yeah, I take your point. For the period that you have a deepening recession, but crude staying high is a danger mark for India and for the rupee. That's a very unhappy combo. But as you say, that may not last for too long. It may be for a shorter period. Vishnu, therefore, final questions. How do you see the rate cycle in India? Are we done and dusted with the market itself expecting the Fed to peak off by 5%? Has India hit the high, or are there more rate hikes?
I think this is where it's a really fine line. We've got very welcome surprises in the drop-off in India's inflation. Whether you look at it from factory gate prices or consumer prices, a lot of it has got to do with food. So I don't know to what extent the RBI will be compelled. I think they probably have at least another hike left in the pocket. So we think that early next year there's one more hike coming through, but then they get a lot more policy space to pause and watch exactly where the Fed goes with this and the attendant risks that come alongside it with respect to capital outflows.
Okay, we'll leave it at that. Vishnu, it's always a pleasure speaking with you. Thank you very much indeed for joining us.
Thank you for having me.
Well, key takeaway, there could be contraction of the US, and that would be bad for Indian exports. There can be a brief period when crude could be sticky, but our exports are not doing well. And that could be a danger period for the rupee, but it would be brief. Largely, India should come out as a stronger entity compared to the other countries. We wrap up on that note on Bazaar. Chartbusters up next.